Let's take a look at how we evaluate investment centers. Remember, cost, profit, and revenue centers will be evaluated using performance reports. This is how we would evaluate an investment center. Investment center managers are like CEOs. They're responsible for profits as well as for investments and how they manage their assets. So to assess performance of investment centers, we rely on two measurements. The first one is return on investment, or ROI. The second one is called residual income. Return on investment is equal to operating income divided by total assets. Be sure to write these formulas down because you will need these in class to do your in-class assignments. Return on investment can be further broken down into two formulas: sales margin and capital turnover. Sales margin is calculated by dividing operating income by sales, and capital turnover is calculated by dividing sales by total assets. So if you know enough of your algebra, you know that these two cancel each other out, giving you return on investment formula, which is operating income divided by total assets. Sometimes this formula you will have to know that return on investment is equal to sales margin times capital turnover, because your questions may not give you all the information. You may need to use some of these formulas to work backwards. One of the biggest benefits of return on investment is that it lets you compare performance across divisions. So divisions of different size can be compared using ROI. Sometimes managers use ROI across time to determine whether a division is becoming more or less profitable over time. You can also use return on investment as a benchmark against other divisions or other companies within the same industry to determine how each division is performing compared to its competitors. The higher the return on investment, the better it is. Next, let's take a look at residual income. Residual income determines whether the divisions have created any excess, thereby residual income above management's expectations. And for this calculation, we incorporate the management's target rate of return. Keep in mind, this is not the investor's target rate of return, this is the management's required rate of return. The residual income is calculated by subtracting minimum acceptable income from your operating income. You calculate minimum acceptable income by multiplying your target rate of return by total assets. Again, a lot of questions will give you management's target rate of return and the investor's target rate of return. The investor's target rate of return will be called weighted average cost of capital, or WACC. But you need to remember that you pick management target rate of return because that is the number we use for the calculation of residual income. Whenever you're evaluating the number that you calculate for residual income, any number you get above zero, so a positive number, means that this division has created residual income above management's expectations. So that's a good thing. The advantage of residual income is that it enhances goal congruence, whereas return on investment may or may not enhance goal congruence. We're not going to get too much into a discussion on that, but return on investment tends to make people look at whether their division is performing a lot better than another division, whereas with residual income, all you're saying is if it's a positive number, then you met what management needs, you're doing well. So residual income enhances goal congruence.